In October of 1929, New York City was glowing. Lights filled office windows. Elevators hummed. Telephones rang without pause. From the street, nothing looked wrong. Inside the banks, money was already disappearing. Not stolen, not burned, not destroyed, just unreachable. Nearly a century later, the buildings are taller, the screens brighter, the systems faster. But the question is the same. What happens when money exists, but access doesn't? This is not a warning. This is not a prediction. This is a historical comparison. It's the greatest financial disasters don't announce themselves. They disguise themselves as stability. By the late 1920s, America believed it had solved economics. Factories were efficient, credit was abundant, stock prices rose almost daily. The newspapers called it the New Era. Economists said recessions were obsolete. Bankers said the system was sound. Politicians said prosperity was permanent. People believed them. Why wouldn't they? A factory worker could buy stocks. A secretary could borrow to invest. Even shoe shiners gave stock tips. This wasn't speculation. It was faith. Faith in institutions. Faith in progress. Faith that the system knew better than history. Money only works when people agree it works. In 1929, trust flowed through banks. Banks held deposits. Banks issued loans. Banks promised liquidity. But here's the part rarely discussed. Banks did not keep your money. They lent it, multiple times. The same dollar existed in several places at once, on paper. Not as long as withdrawals were slow. The illusion held. But the moment confidence cracked, the system faced a truth it was never designed to survive. It didn't start with panic. It started with hesitation. A few investors sold, the prices dipped. Banks tightened credit. Suddenly people wanted cash, not numbers, and banks couldn't deliver. Not because they were corrupt, but because the system assumed trust would never vanish. That assumption was wrong. Now fast forward. Today's saver doesn't visit a bank. They open an app. Their balance updates instantly. Transfers feel effortless. Access feels absolute. But modern money is even less physical than in 1929. There is no vault. There is no pile of bills. There is only permissioned access to a ledger. And that ledger is optimized for movement, not withdrawal. In both eras, people trusted the system. Institutions relied on leveraged stability, depended on confidence. Savings funded risk elsewhere. The difference? In 1929, banks failed openly. Today, systems remain operational while quietly restricting behavior. The Great Depression taught governments a lesson: never allow visible collapse. So modern crises are engineered differently. Instead of failure, management; instead of collapse, containment; instead of loss, delay. And savings become the buffer. In 1929, people lost money because banks closed. Today, people may lose money because banks stay open. The doors don't shut, they narrow, and history tells us exactly how that story ends, if we know where to look. Most people believe money is something you have. In reality, money is something you're allowed to use. That distinction didn't matter much when money was physical. It matters everything now. To understand why savings become trapped, we have to dismantle a myth that exists in both 1929 and today. The idea that banks store money. They never did. In both 1929 and 2026, the system runs on the same engine: fractional reserve banking. Here's the simplest way to understand it. Imagine 10 people deposit $1,000 each into a bank. The bank now shows $10,000 in deposits. But it doesn't keep $10,000. It keeps a fraction. It lends the rest. That loan becomes someone else's deposit, which is then lent again and again. On paper, the system has created more money. In reality, it has created more claims on the same money. This only works if not everyone withdraws, confidence remains intact. Time smooths out demand. 1929 shattered that illusion. When confidence cracked in 1929, people didn't panic immediately. They withdrew cautiously. But even cautious withdrawals exposed a fatal truth. Banks didn't have the money. They never planned to. They planned for averages, not extremes. As withdrawals increased, Banks were forced to sell assets at losses, call and loans freeze credit. This caused businesses to fail, which caused unemployment, which caused more withdrawals. A feedback loop. By the time panic arrived, the system was already dead. Modern defenders of the system say, that can't happen again. Technically, they're right, because the system changed its failure mode. Instead of allowing bank runs, we engineered friction. In 1929, money was tangible. Cash could be withdrawn, gold could be demanded, banks could be emptied. Today, your money exists as database entries, clearing permissions, settlement instructions. You don't hold money. You hold access rights. And access rights can be delayed, limited, suspended, conditional, not arbitrarily, but legally. Banks don't usually fail because they're broke. They fail because they're illiquid. Liquidity means assets exist but can't be converted to cash fast enough. In 1929, illiquidity caused failure. Today, illiquidity triggers intervention. Central banks step in. Governments backstop. Rules change mid-game because collapse is politically unacceptable. So instead, access becomes managed. 1929-2026 cash-based, digit-based bank runs, access friction. Visible collapse, invisible containment, immediate loss, slow erosion, panic, compliance, both end the same way. Savers absorb the shock. The most dangerous belief is, if my money is in my account, it's safe. Safety is not about existence. It's about control. And control is conditional. The Great Depression exposed what happens when money disappears. The modern era hides what happens when access disappears. Your savings don't vanish. They become anchored. It's held in place, used elsewhere, released on someone else's timeline. And the system calls this stability. History remembers October 29, 1929, as the moment everything broke. Black Tuesday. Panic selling. Men jumping from windows. That image is convenient. Suggests collapse was sudden, accidental, unavoidable. The truth is far more disturbing. The system didn't break in one day. It unraveled slowly, while authorities hesitated and then reacted too late. By early 1929, the warning signs were everywhere. Industrial production slowed, consumer debt climbed, stock valuations detached from reality, bank credit expanded dangerously, but optimism drowned caution. Why? Because confidence had become policy. Admitting risk meant admitting failure. So leaders chose silence. The stock market of the 1920s wasn't driven by earnings. It was driven by borrowed money. Investors bought stocks with as little as 10% down. Prices rose, profits multiplied. If prices fell, losses did too. Banks were exposed not directly, but through loans tied to collapsing assets. This is where savings enter the story, or deposits funded leverage. In October, selling began cautiously. Then prices fell. Margin calls followed. Forced selling accelerated. Banks called loans. Credit vanished. Businesses collapsed. Unemployment surged. The market crash was only the trigger. Depression came from what followed. Between 1930 and 1933, over 9,000 U.S. banks failed. Millions lost savings permanently. Entire towns lost financial infrastructure. Banks didn't fail because they were evil. They failed because they were interconnected. One failure stressed another. Liquidity evaporated. And without a lender of last resort strong enough, the system imploded instead of immediate intervention. Policymakers raised interest rates, cut spending, defended gold reserves. These actions protected the system's rules, not the people inside it. The result? Deflation. Prices fell. Wages fell. Debts stayed the same. Savings didn't just disappear. They became worthless relative to obligation. More damaging than economic loss was trust destruction. People stopped believing in banks, markets, institutions' promises. Once trust breaks, recovery becomes generational. This is why the Great Depression reshaped politics, culture, and law. Governments drew one conclusion: never let this happen in public again. Not, never let people lose savings, but never let systems visibly fail. That distinction matters. From the ashes of 1929 came deposit insurance, central bank intervention, capital controls, regulatory expansion. These tools were designed to prevent panic, not necessarily loss. Loss would still occur, just quietly, gradually. 1929 taught leaders that collapse is unacceptable, so modern crises are managed, not endured. The system absorbs shock through inflation time restrictions. Policy shifts, savings become the cushion. Stability is not free, it requires sacrifice, and that sacrifice is rarely voluntary. In the Great Depression, savers lost money openly. In modern systems, savers lose control silently. Just as in 1929, debt levels are extreme, policy tools are constrained, confidence is fragile, inequality is widening, but today, collapse looks different. There are no closed bank doors or delayed transfers. The Great Depression was not a market failure. It was a liquidity failure, compounded by policy delay. Modern systems remove delay, but at the cost of transparency. 1929 was loud. It forced reform through suffering. Today's system is quiet. It enforces stability through control. And the price is paid, not in panic, but in access. In 1929, collapse required failure. Banks had to shut, markets had to fall, people had to see the damage. In the modern era, collapse requires only one thing: control of access. It's not confiscation, not destruction, just control. This is why the next crisis won't look like a crisis. It will look like policy. By the mid-2020s, the global financial system is under a unique strain. Not from one shock, but from stacked pressures, record sovereign debt, persistent inflation, higher interest rates, aging populations, declining productivity, political instability. Each problem alone is manageable. Together, they create a situation where liquidity becomes political. Governments don't repay debt, they roll it over. For years, this was easy. Rates were near zero. Central banks bought bonds. But as rates rise, rollover becomes expensive. Every percentage point increase in rates expands deficits, forces austerity or monetization. Pressures banking balance sheet savings sit at the center of this mechanism. Modern banks appear strong. Capital ratios look healthy, stress tests show resilience, but the danger is not default, it's duration. Banks hold long-term bonds purchased at low yields. When rates rise, bond values fall unrealized, losses grow, capital becomes theoretical as long as deposits stay put. This doesn't matter. Withdrawals turn theory into reality. There is an unspoken rule in modern systems: deposits must remain stable. This is why withdrawals are monitored, transfers are flagged, cash usage is discouraged. Digital rails are favored not to spy, to stabilize. Capital controls sound extreme. They're not. They already exist quietly. Limits on daily transfers, international wires, cash withdrawals, large transactions. These aren't emergency tools. They're pre-installed features. Freeze implies danger. Modern systems use softer language, temporary restrictions, liquidity management, anti-money laundering risk protocols. The result is the same. Access slows, and time becomes the tool. Digital money is efficient, it's also precise. Rules can be embedded. Where money goes, how fast it moves, what it can purchase. This isn't tyranny, it's risk governance. But risk governance requires compliance. Instead of blocking access outright, inflation does the work slowly. It reduces the real value of savings. It transfers wealth silently. It stabilizes debt burdens. Inflation is not a failure, it's a feature. After 2008, the rules changed. Banks were no longer guaranteed bailouts. Depositors became part of the solution. In a bail-in, equity is wiped, bondholders take losses. Depositors are converted or restricted legally. Orderly, predictable. Savings become capital. Crashes force reform. They also cause unrest. Modern systems prefer managed decline. Growth slows. Living standards erode. Savings lose power. Access tightens. No headlines. No riots. Just adjustment. People accept restriction when it feels temporary, and temporary measures have a way of becoming permanent, because removing them feels risky. If you withdraw, you signal stress, you accelerate controls. If you stay, you absorb inflation, you surrender control. There is no dramatic choice, only trade-offs. Modern resets don't announce themselves. They unfold through policy tweaks, regulation changes, incentives and penalties, Narrative shifts, savings don't vanish. They are recontextualized. 1929 taught leaders what happens when confidence collapses publicly. 2026 is about ensuring it never does. Even if that means confidence is managed instead of earned. The system no longer fears collapse, fears loss of control, and savings are the control mechanism. Not because savers are villains, but because savings represent stored trust. And in a stressed system, trust is rationed. After every financial collapse, historians ask, what went wrong? But the more important question is never asked. Who paid for stability? In 1929, the answer was obvious. Banks failed. Savings vanished. Families lost everything in public view. Today, the answer is harder to see, because the cost is hidden in time, access, and silence. Never before in history have people saved more money and trusted it less. Accounts are insured. Banks are regulated. Systems are stress-tested. Yet anxiety remains. Why? Ain't. Because modern savers sense something instinctively. Ownership no longer guarantees control. Savings are not idle. They are bank funding, government debt buyers, market stabilizers, confidence anchors without savings. The system becomes volatile. So the system protects savings, but not for the saver. For itself, in 1929, money was a right. If you had it, you could demand it. Today, money is a permission. Granted by banks, networks, regulators, algorithms, permissions can be adjusted. Quietly, the Great Depression reshaped morality. Saving was virtuous, debt was dangerous, speculation was shameful. The modern era reversed this. Debt fuels growth, saving slows velocity. Consumption stabilizes demand. So savers are subtly discouraged. Low rates, inflation, fees, not punished. Outrage requires clarity. Modern losses lack drama. No bank doors slam shut. No vaults are emptied. No headlines scream gone. Instead, purchasing power slips, access narrows, options disappear. Slow enough to normalize. Older generations remember bank failures. Younger generations remember freezes, delays, and technical issues. Different experiences, same lesson. System adapts. The cost transfers. Safety is not permanence. It is priority. When systems are stressed, they choose. Order over freedom, stability over fairness, control over consent. This isn't conspiracy. It's design. No lines, no panic, no collapse montage. Just transfer limits, emergency rules, policy justifications, gradual acceptance. The suffering would be quieter, which makes it more effective. People say history repeats itself. It doesn't. It rhymes. 1929 taught governments what visible failure costs. 2026 shows how invisible failure works. These savings are not just personal security. They are systemic leverage. Leverage is never neutral. If your savings help stabilize the system, and the system can restrict access to protect itself, then ask yourself, who does your money really work for? In 1929, people learned too late that trust was fragile. Today, trust still exists, but it is conditional, and conditions change when systems are under pressure. The next collapse won't announce itself. It won't arrive with sirens or headlines. It will arrive as policy, as updates, as limits, as time. Most people won't call it collapse at all. They'll call it stability. So here's the question history leaves unanswered. If access can be limited to protect the system, do you really own your savings? Or are you lending trust to something bigger? Leave your thoughts below, because the most dangerous collapses are the ones that never look like collapse.